Good morning, welcome to Morning Markets. Today we're going to be focusing on US interest rate, the decision yesterday and what the market reaction was. The big event for markets this week was yesterday's interest rate decision from the Federal Reserve, the US Central Bank, who decided to leave interest rates unchanged at 5.5%. Interest rates important for the economy, important for mortgage holders, and also just corporates and households taking out loans. There was a statement published by the Federal Reserve who talked about the economic growth environment slightly stronger, seeing some slight cooling within the labour market, but on the whole still firm. One key release was a summary of economic projections. So this is every member on the committee giving their estimates for economic growth, interest rates, inflation and unemployment from here out to 2026. So we haven't received this since June this year. Looking at the details, the key change was on the interest rate side. No change for this year. Committee members are expecting one more 0.25% increase to interest rates before the year ends. But next year was where the big change came in. Previously, they expected interest rates to be cut by 1%. They're actually forecasting interest rates to be cut by only 0.5%. So that means that interest rates will be higher for longer and monetary policy will be more restrictive for longer. And that's because economic growth is holding up better than expected. Looking at the projections, they're expecting economic growth to be 2.1% this year rather than 1%, and they also revised up 2024 estimates slightly. And that reflects also on unemployment. Unemployment is expected to be stronger, revising down their previous estimates by 0.3 to 3.8% this year, and also revising down 2024 and 2025 unemployment estimates, which is a good thing. More people employed should help support consumption and economic growth. And then on the inflation front, again, inflation forecasts were revised down by 0.2% to 3.7% for this year, leaving 2024 estimates unchanged. So the key takeaways really being that interest rates higher for longer, which is because the economy is still very strong. There's still inflation pressures in the system and above their 2% target. So they want to make sure that inflation comes down sustainably. So therefore keeping monetary policy restrictive is necessary. How did the market react? Well, we saw negative returns from US equities following the release. So the US market was down just under 1% for the S&P 500. The Nasdaq was down 1.5%. We saw a bit of weakness also in US government bonds as bond yields rose, and we saw a little bit of strength coming through on the US dollar. Today, all eyes will be on the central bank here in the UK, the Bank of England, where they've been boosted this week by the inflation report, which was released yesterday. Inflation came in below estimates, which was very pleasing on headline and core inflation. But the expecting is still that interest rates will be put up today, going from 5.25% to 5.5%. We'll provide the details tomorrow. That's everything from us. Thank you for watching.